Starting this tax year, a new federal provision could shield over $44,000 of a retired couple's income from federal taxes. It's called the Senior Bonus Deduction. It expires in 2028. It's not automatic, and most Americans over 65 have never heard of it. That blind spot alone could cost eligible retirees $1,300 a year, money they'll never recover without knowing exactly how to claim it. Helen turned 65 last December. She's retired, living on her pension and Social Security, and she files her taxes every spring like clockwork. But this year, something is different. For the first time, the IRS has created a new deduction that directly targets seniors like her. Anyone who is 65 or older by December 31st of the tax year can qualify, whether you're single, married, filing jointly, or the head of your household. The rule is simple on the surface. If you meet the age requirement, you're in the running. But there is a catch. This deduction isn't automatic. You have to claim it on your return. If you miss it, you lose it. Most seniors aren't hearing about this from their usual sources. The IRS hasn't mailed out special notices. Tax software won't prompt you unless you answer the right questions. Even many professional preparers are just starting to catch on. The Senior Bonus Deduction applies for tax years 2025 through 2028, and after that it's gone. No extensions, no second chances. There's no benefit if you file as married filing separately, and you must have a valid Social Security number and U.S. residency status. The deduction is available whether you take the standard deduction or itemize, and it stacks on top of the existing age-based extra deduction most seniors already know about. Helen, like millions of others, could be eligible right now. But unless she pays close attention and follows the right steps, she could leave hundreds or even thousands of dollars on the table. In a world where every dollar counts, missing out on this deduction could mean the difference between covering a medical bill or not. The rumor that this rule wipes out all taxes on Social Security isn't true, but the real opportunity is still significant, especially for those who take action before the window closes. Frank and Gloria, both in their late 60s, sit at their kitchen table each year, sorting through tax forms and receipts. This time the numbers look different. For the first time, their return includes a $12,000 bonus just for being over 65 and filing jointly. For a single filer like Frank's sister, the amount is $6,000. These are not small figures. They stack on top of the standard deduction, which for 2025 is $31,500 for married couples and $15,750 for singles. Add in the regular age-based extra, $3,200 for a couple, $2,000 for a single, and the total deduction for Frank and Gloria climbs to $46,700. That's nearly enough to shelter their entire Social Security and pension income from federal taxes. The numbers alone are startling. For many, this means shielding more than $44,000 of retirement income from federal tax, something that was simply out of reach before. And the impact is immediate. In the 22% tax bracket, a $6,000 deduction puts $1,320 straight back in a retiree's pocket. For a couple, the $12,000 bonus can mean $2,640 in savings, enough to cover several months of prescription costs or a year of Medicare premiums. This is not a replacement for the standard deduction. It's a bonus that stacks with every other age-based benefit. But there's a catch. It's only available for tax years 2025 through 2028. After that, the opportunity disappears. Frank and Gloria's story is a reminder. Missing out could mean giving up thousands of dollars, all because the deduction isn't automatic. It has to be claimed, and the window is closing fast. The Senior Bonus Deduction stands out for its flexibility, but there's a catch that can't be ignored. Seniors can use it whether they claim the standard deduction or choose to itemize. That means it fits nearly every tax situation, From those who keep things simple to those who track every medical bill and charitable gift. It doesn't matter which path you take, this deduction still applies and stacks on top of any age-based benefits you already receive. But the clock is ticking. The deduction is only available for tax years 2025 through 2028. After that, it vanishes, with no guarantee Congress will renew it or bring it back in any form. Missing this 4-year window could mean missing out for good. Unlike some tax breaks that quietly roll forward, this one is designed to sunset. If you wait too long or assume it will always be there, you risk losing thousands of dollars in potential savings. Filing early in the window, or at least not waiting until the last eligible year, gives you more control and more chances to benefit. The deduction isn't tied to a single filing method, so even those who itemize for medical expenses or mortgage interest can still claim it. The only requirement is that you're eligible and you actively claim it on your return. There's no automatic enrollment. For seniors who plan ahead, this is a rare opportunity, but it's also a deadline you can't afford to ignore. The difference between acting now and waiting could be measured in real dollars lost, all because of a rule that disappears after 2028. Not every senior will receive the full benefit. The senior bonus deduction is designed with income boundaries that can shrink or even erase the deduction for higher earners. For single filers, the phase-out starts once modified adjusted gross income, MAGI, hits $75,000. For married couples filing jointly, the line is $150,000. Every $1,000 above these marks chips away $60 from the deduction. That means a single retiree with $80,000 in MAGI would lose $300 of the $6,000 bonus, leaving $5,700. If a couple's MAGI is $160,000, $10,000 over the joint threshold, their $12,000 deduction drops by $600, down to $11,400. The reduction continues dollar for dollar until the deduction disappears completely at $175,000 for singles and $250,000 for couples. This formula matters. Even partial phase-outs can mean hundreds or thousands left unclaimed. The calculation uses MAGI, which includes most income sources like Social Security, pensions, and investment earnings. Understanding where your income falls is the first step to knowing how much of the deduction you can really use. Claiming the senior bonus deduction starts with the right paperwork. For tax years 2025 through 2028, eligible seniors must use Form 1040-SR, the version designed for filers age 65 and up. On this form, the age 65 checkbox confirms eligibility, but that alone is not enough. The key step is completing the new Schedule X. This worksheet asks for your modified adjusted gross income, applies the phase-out formula if your income is above the threshold, and calculates the exact deduction you can claim. Once you have that number, transfer it to line 10 of Form 1040-SR. That's where the deduction officially enters your return. Tax software can help, but it only works if you answer the eligibility questions correctly. The deduction will not appear by default. If you use a preparer, remind them to include Schedule X and double-check your age and income details. For married couples, both spouses must be 65 or older to get the full $12,000. If only one qualifies, the deduction is $6,000. After entering the amount, the deduction reduces your taxable income before any tax is calculated. There's no need to itemize. This bonus stacks on top of the standard deduction and the regular age-based extra. Missing any of these steps could mean losing out entirely. Once the return is filed, there's no automatic review, and the IRS won't add the deduction for you. The opportunity is real, but it takes action to secure the savings. Rumors have spread that the senior bonus deduction wipes out all taxes on Social Security income. That's simply not true. The deduction doesn't change the formula that decides how much of your Social Security is taxable. Those rules still hinge on your combined income, with thresholds set at $32,000 and $44,000 for married couples, and $25,000 and $34,000 for singles. What the new rule actually does is more subtle, but still powerful. By stacking an extra $6,000 deduction for singles or $12,000 for married couples on top of existing benefits, it can push a retiree's taxable income down enough to reduce their tax bill significantly, even if it doesn't erase Social Security taxes outright. Helen's situation makes this clear. If she's in the 22% tax bracket, a $6,000 deduction puts $1,320 right back in her pocket. That's money that could cover a year's worth of prescription drugs or pay for a new pair of hearing aids. But this opportunity only exists if you claim it. Scams and misinformation are everywhere, with some websites promising to unlock secret Social Security refunds. The real savings come from following the IRS rules, filling out Form 1040-SR and Schedule X, and making sure you're under the income phase-out thresholds. Missing this step isn't just a missed chance, it's a costly mistake. Right now, overlooking this deduction means real money left on the table, up to $1,320 in tax savings for many seniors per person every year. This rule stacks on top of existing deductions, but it is not automatic and expires after 2028. Miss it, and you risk missing out for good.